Here's what's happening in self-storage and why it matters. Right now, in many secondary and tertiary markets, there simply aren't enough buyers. In some cases, sellers aren't negotiating against other sellers, they're competing for one or two serious buyers in the entire market. As a result, we're seeing pricing resets that would have been hard to imagine a few short years ago. Some assets are trading at pre-COVID pricing, and in certain situations even lower. And it's not just price that's shifting, it's structure. Seller carry is back in a meaningful way. Larger discounts are being discussed openly. Terms that would have been dismissed in 2021 are now part of normal negotiations. Sellers understand the buyer pool is thin, and if they want to transact, they have to be flexible. But here's where it gets interesting. Primary markets, major metros with deep capital and institutional presence, are still seeing significant activity. Assets in those markets continue to trade, and cap rates there are often roughly half of what we're seeing in the secondary and/or tertiary markets. Capital feels safer in those environments, so it tends to concentrate there. The disconnect is how risk is being priced. Operationally, a well-located, well-managed asset in a strong secondary market doesn't carry dramatically more risk than something in a primary market. The day-to-day realities, tenant turnover, expense control, and rent growth are often very similar, but pricing suggests a much wider risk gap than actually exists. When more buyers begin to recognize that, we should see capital gradually move back into secondary markets. As that happens, the buyer pool expands, cap rates compress, and transaction volume returns. Not overnight, but over time. Until then, this is a market that favors disciplined buyers who can move, structure creatively, and focus on real cash flow instead of stories. This is the Self-Storage Syndicator, focused on real deals, real operators, and long-term value.